Heya Cryptozens, welcome back to the Crypto Overnighter. My name is Nikodemus and we do crypto news analysis nightly at 10 p.m. And keep in mind, none of this should be considered financial advice. And it's Sunday, March 19th, 2023. Switzerland's financial regulator and the Swiss National Bank think that UBS should buy investment bank Credit Suisse. They think this is the only way to avoid losing people's trust. Now, honestly, I don't know that this is going to help with the trust factor. A report from the Financial Times on March 18th said that Switzerland is getting ready to use emergency measures to speed up the takeover. That's because they want to make sure that the acquisition is completed before the markets open on Monday. Now, according to this report, emergency measures would let the deal happen without a vote from shareholders. This is different from normal Swiss rules, which usually require a 6-week waiting period for shareholders to discuss the takeover. So the Swiss National Bank and the Swiss Financial Market Supervisory Authority, or FINMA, they're trying to come up with an agreement about regulations. And they have also told other countries that they think UBS is the only solution to stop people from losing trust in Credit Suisse. Now, UBS plans to continue Credit Suisse's idea of making the investment bank smaller. This new combined bank would be no more than 1/3 investment bank. UBS has $1.1 trillion in assets, where Credit Suisse has $575 billion. Now, keep that in mind. UBS has $1.1 trillion in assets. If these two banks merge, they will become one of the largest and potentially most important financial institutions in Europe. And breaking news, I just found out that the Swiss National Bank is going to provide $100 billion to backstop UBS's purchase of Credit Suisse. The shareholders at UBS don't get a vote. The citizens of Switzerland really don't have a say in this. That's right. According to the Financial Times, Swiss authorities are going to change the country's laws to make this legal. That's how desperate they've become. Desperate to protect a crumbling, decaying system. And so, UBS collects Credit Suisse for $2 billion. It was a $7 billion company on Friday, and the Swiss government is going to make it risk-free for them. And nobody gets a vote, not the shareholders, not the citizens. So this is why we need crypto. Now, what happened? UBS Group agreed to purchase Credit Suisse for almost $2 billion in a groundbreaking deal for the two largest banks in Switzerland. The Financial Times reported that UBS doubled its initial offer to acquire its rival. On March 18th, UBS offered $1 billion, but Credit Suisse's board declined the proposal. Data from Companies Market Cap shows that Credit Suisse's market value on March 17th was nearly $8 billion, so that $2 billion deal was a hell of a discount. Now, as part of the deal between UBS and Credit Suisse, Swiss authorities agreed to adjust the country's laws. This change allowed the deal to bypass a shareholder vote and be announced over the weekend before the markets opened. Typically, you'd have that 6-week cooling off period. Not so in this case, hence the need to change the law. Additionally, the Swiss National Bank committed to offering UBS more than $100 billion in liquidity. The Financial Times reported that SNB and Swiss Financial Market Supervisory Authority had a lot to do with making this deal work. Regulators in the United States and in Europe approved this agreement, and coordinated statements were expected to be released on Sunday. Over the weekend, Swiss authorities evaluated alternative options to Credit Suisse in the event that the deal with UBS fell through. One of these emergency options was a full or partial nationalization of the bank. That would have been exciting. Credit Suisse's rescue plan would require bondholders to take losses. This raised concerns among European regulators. They worried that this move could negatively impact investor confidence in the financial sector in Europe. Since March 15th, UBS and Credit Suisse have been negotiating with regulators. This was after the Saudi National Bank said that it was not legally allowed to pour more liquidity into the failing bank. Credit Suisse was established in 1856 to finance the development of Swiss railroads and was the second largest bank in the country. Silicon Valley Bank's UK arm has reportedly given millions of pounds in bonuses to its employees after being bought by HSBC for only £1. These bonuses were authorized by HSBC earlier this week. This news comes just a few days after the bank acquired SVB UK. Now, according to insiders, it's unclear how much SVB UK's CEO, Erin Platts, or her senior colleagues received in bonuses. That said, they described the bonus pool as modest, amounting to between 15 and 20 million pounds. Sources said that the bonuses would not have been paid this week if HSBC had not acquired SVB UK solvently. One insider pointed out the stock owned by senior executives and employees became worthless due to the near collapse of the company. Reportedly, the bonus payments were intended to show HSBC's confidence in the talent at SVB and to retain key staff. They also mentioned that the payments were in line with previously agreed upon amounts. On March 17th, SVB tweeted that they were pleased to be part of HSBC. This after 14 years of supporting and growing the UK's innovative economy. On March 10th, the Bank of England closed down SVB's operations because it had only a limited presence and did not provide critical functions for the financial system. The Bank of England stated that SVB UK would no longer accept deposits or make payments, and that it would apply to the court to put SVB UK into a bank insolvency procedure. SVB's US banking arm was taken over by the FDIC. On March 17th, SVB Financial Group, the holding company, they filed for Chapter 11 bankruptcy protection as they continue to search for buyers for the other assets. The chief restructuring officer of SVB Group, William Costeros, said that Chapter 11 process would allow SVB Financial Group to preserve its value as it considers strategic alternatives for its valuable businesses and assets. Costeros also noted that SVB Capital and SVB Securities would continue to operate led by their independent teams. The Mid-Size Bank Coalition of America is made up of, mid-size U.S. banks. They have requested the U.S. FDIC to extend deposit insurance for the next 2 years. The coalition sent a letter to the FDIC stating that this move would stop the outflow of deposits from smaller banks. They believe that covering all deposits would bring stability to the banking system, boost economic growth, and enhance public confidence. In addition, the coalition suggested that the extended insurance would stabilize the banking sector and reduce the likelihood of additional bank failures. To finance the insurance program, they suggested that banks increase the deposit insurance assessment on lenders who choose to participate in the extended coverage. This proposal would enable the banks to fund the programs without relying on taxpayer dollars. John Deaton is the creator of Crypto Law Lawyer. On March 19th, he took to Twitter to warn his followers that without a guarantee from the FDIC, up to 300 banks could fail. The warning follows analysis by economists published on March 13th. This analysis found that many banks are in danger due to uninsured deposit withdrawals. The FDIC's failure to provide guarantees could lead to a significant loss of public confidence in the banking system. It could ultimately lead to the collapse of hundreds of banks. That analysis highlighted that the withdrawal of half of uninsured depositors could lead to almost 190 banks at risk of impairment to insured depositors. This would potentially put $300 billion of insured depositors at risk. The report shows just how alarming the situation is, and that it requires immediate action to restore public confidence in the banking system. Representative Tom Emmer is the majority whip in the United States House of Representatives. He questioned the FDIC's decision to weaponize recent instability in the banking industry and to eliminate legal crypto activity from the United States. In a letter to FDIC Chair Martin Grunberg on March 15th, Emmer voiced his concerns about the regulator's actions. He noted that crypto innovation has the potential to benefit consumers and to enhance the financial system. Emmer cautioned that the FDIC's actions could cause significant financial instability, and that they are highly unsuitable. He expressed his concerns about the potential for negative consequences on the broader financial system. We know that Michael Barr is the vice chair of supervision, and he is supervising a review of Silicon Valley Bank's regulation and supervision following its failure. This review is set to be publicly released by May 1st. Economist Peter Schiff has compared the current banking situation to the 2008 financial crisis. He thinks that increasing banking regulations is making the economic crisis worse. According to Schiff, the 2008 financial crisis was caused by excessive government regulation, so not just the collapse of the housing market. After the crash, the government introduced more banking regulations, and then they promised that something like this would never, ever happen again. Now, Schiff criticized this approach. He said that too much government regulation caused the 2008 crisis. He said that the current crisis will be even worse because of too much government regulation. Now, Schiff believes that striking a balance between the regulations and banking institutions is crucial. This is especially significant for him because his bank was closed down by Puerto Rico regulators on July 4, 2022. After Schiff's bank was shut down, the cryptocurrency on Twitter reminded him why so many people advocate for Bitcoin adoption to achieve financial freedom. You wouldn't know it by reading the headlines, but at one point in time, Sam Bankman-Fried was a well-respected figure in the crypto community. However, allegations of misusing users' funds led to FTX's collapse and SBF's downfall. In May of 2022, an email exchange allegedly leaked. This exchange purported to show that Sam had invited the Federal Deposit Insurance Corporation chairman Martin Gruenberg to meet him in June. This email was facilitated by Mark Wetchen. Now, he's the former CFTC commissioner who joined FTX US as the head of policy and regulatory strategy back in November of 2021. Towards the end of the email, Gruenberg was told that FTX was requesting the federal government to regulate them. This is an unusual situation for a company. He also mentioned that they had submitted an application to the CFTC, outlining how the agency could regulate them. Wetchen explained that if the CFTC approved their application, other major U.S. exchanges with CFTC licenses would follow suit. And so, after receiving Sam's invitation, Gruenberg agreed to meet with him. When FTX collapsed, investigations revealed Sam's political connections, and an FDIC spokesperson confirmed that their chairman had met SBF as part of routine courtesy visits. In related news, on April 4th, FTX plans to auction off Ledger X. Lawyers for FTX filed revised dates on March 18th in a U.S. bankruptcy court in Delaware. This auction will be at the offices of Sullivan & Cromwell, and a sale hearing will happen on March 12th. After the auction, the successful bidder will be announced within one business day. This auction was supposed to happen on March 7th. Then it got moved to March 22nd. There has been no explanation given for the date change. FTX got approval earlier this year to sell its business units to raise funds for its creditors. FTX is also looking to sell Embed Financial Technologies, FTX Japan, and FTX Europe. Around 117 parties have shown interest in purchasing FTX's various entities. On October 2021, FTX's US division acquired Ledger X, which was later renamed FTX US Derivatives. A hacker did a very bad thing to General Byte's Bitcoin ATMs. They put their own Java app on them. Now, this let the hacker read and decrypt API keys. These keys could then be used to drain money from exchanges and hot wallets. General Bytes posted a warning about this on March 18th. The hacker got into the database and took users' names and passwords. They also turned off two-factor authentication, which is a big deal. They looked at the terminal event logs to find times when people scanned private keys. The hacker accomplished this by doing a couple of things. First, they put their own Java app on the Bitcoin ATMs. And then second, they used the master service interface to run the app remotely. This interface is usually used for uploading videos to the server in the ATMs. The hacker got into both the cloud service and the standalone servers of General Bytes, who is shutting down its cloud service. The company said that it's hard to protect a system that many people can access at once. Some of those people might be bad. They also said that they would help their customers move from the cloud service to their own standalone servers. The company shared steps that people can use to attack the problem. They also said that they'd done many audits since 2021, and this issue has never come up before. The security post gave information about the attackers' crypto addresses and APIs. Now, people who checked the blockchain found that the attacker had 56 Bitcoin in their wallet, which is about $1.5 million. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, please like, follow, subscribe, leave a rating or a review. And in the meantime, we'll see you tomorrow night.